Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 10th edition of Market Outlook. So you had quite the fireworks this week on the heels of great jobs report and a growing economy. Certainly good signs overall. And let's get into the charts right away. And also don't forget to sign up at MarketGauge.com and get this newsletter free every week. Okay, the first charts that we have here, these are charts of the S&P and of NASDAQ. And I put in some longer term channels because they've sort of been bounding very interestingly across these channels here. And also what I have in here are a series of composite indicators of the market internals, sentiment, all added up and broken down into what I would consider short term, which is good for indicating day trades, to mini swing and swing to position. So the top half of these charts here, these indicators, that's the short term indications. The bottom charts are the longer term, and again, these are about 22 different indicators that we've put together for both NASDAQ and the Qs and S&P. One thing you can see for sure is that the S&P has been running a bit rich. Now the maximum you can go on this is only a -2. We're at a -1, so on a short-term basis you're definitely overbought. Now longer term we're on a +2. That's swing to position trades. That's looking really positive. It's been in a positive mode basically since November, the elections. As you can see, we've been green across the board, moving back and forth between moderately to very positive. Right now we're at very positive. However, definitely on a shorter term basis is favoring taking some short trades on a day trading or on a mini swing basis. Now the other thing to note is this parallel channel here. We have now bounded, and it's really, you can see, a pretty accurate channel. And just on Friday we closed at or slightly above it, so we're accelerating to the outer side of this channel. But in a moment I'm going to show you that price is also overbought as well on the relative strength index. So you can see why we're getting some overbought readings here. So when you're fully extended after a huge move at the upper end of the channel, definitely merits some caution, even though the longer term trend is still intact. Completely different picture here in NASDAQ. As you can see, we're still trading in the middle of that channel. I mean, a lot of this is been hijacked or held up by Apple, but nonetheless a similar picture on the longer term, very positive. You can see the 50 over the 200 definitely favoring swing and longer term type of trades. And interestingly, on a shorter term basis we're actually positive, where the S&P is negative. So that's the overall picture. Let's go through some other charts here. Let's see what we have. Here is let's take a look at the VIX. You can see the VIX, as we had indicated last week, we were trading basically under the 50-day moving average and under the 200. The VIX indication sentiment still extremely positive. A lot of people were expecting a big follow-through potential on the downside in the market, as the VIX on that one big down day based on the Italian elections really spiked the market, but it's come back down into its normal trading range. So you can see here that the VIX or sentiment is still very, very strong, and you've got basically you're trading within the middle of the Bollinger Band, so it's not huge exuberance on the plus side. So that's also a positive sign. Longer term, you can see we're just sort of hovering around the lower end, which is overall positive. Again, we're under the longer term 200-week moving average, and so that is positive. Also in the middle of the weekly Bollinger Bands. Again, all this points to positive feelings here about the market, but not excessive. Let's take a look at interest rates. As you know, we've been looking at the TLTs and the TBTs. Right here, we had a declining 50-day moving average. You attacked it. Again, a bearish phase. We broke through really important support here. If you look at the weekly chart, you can see we broke down over, oh gee, this is going back to almost all of 2012. We're basically trading all under 2012. Also to take notice that the 65-week moving average has flattened out, and now we're turning down. The one caveat here is that the relative strength on a daily basis is extremely oversold. So yes, you may have a little bit more follow through, but basically on a short-term basis, a little bit of a bounce here would not be out of the question, considering how this thing has fallen apart. But it looks like, as we've been saying, that the long-term trend in interest rates has reversed from extremely long-term down move, right, upward prices in rates to a change. And you might have seen the all-time lows put in for a long time, going back to the mid part of 2012. So rallies need to be sold. At this point, if you didn't catch this short here, which we certainly put out last week and the week before, and actually over the last several months, we've been looking at this failing that failing weekly trend in the TLTs, and here you have a pretty good confirmation. Also interesting to note, big volume on the sell-off. So yes, you might get a little bit more follow-through, expect to bounce, and again, bounces need to be sold. Let's go back a little bit more into the market internals on the S&P. As you can see, the McClellan oscillator on the S&Ps not overbought at all. So there is potential for more movement to the upside. Again, we sort of came close to testing the lower end of the McClellan oscillator, which is intermediate indicator, good for swing to position traders, and you can see you got plenty more on the upside. Now, interesting to note, we are running a bit rich, although we haven't generated a bona fide sell signal based on the advanced decline data, because that breadth is extremely strong. We're at higher readings, but again, we need to hook down and turn down to generate a sell signal, which should be confirmed by up-down volume, which is not running quite as strong. But again, you're still above that that level that would generate a short-term sell. Okay, another thing that I wanted to cover, since it is the feature on our text part of the newsletter, is gold. And as you know, we've been overall fairly negative on gold for quite some time, along with the rising interest rates, which are very unfriendly to easy money and inflationary tendencies. So gold is very, very sensitive to that. And what do we have here? Number one, you can see the chart here. This is a daily chart on gold. For one, you had the death cross a couple of weeks ago. We had already been trading under the 200-day moving average, of course under the 50, and we've just been really sitting here. So it's interesting because we also had, besides this slope, this accelerating downside slope, which has been basically in effect for quite some time now, right? Since late October, early November, we've been basically a declining 50-day moving average. And you can see the market really, really respected that. Right now, let's take a look. You can see, very interesting, that this whole thing could be a massive top. I mean, if the TLTs, interest rates continue up, that's going to put pressure on the gold bugs. There's no question about that. You can already see that unfolding. So even though we had, expansionist monetary policy, although there's some indications from the Fed that that might not continue, or they may abate some of that, it's certainly taken a toll on the gold market. And this whole thing here could be a massive top. Now, critical level, it's very interesting. You can see that we have not been able to really close beneath the 150 level. There have been a couple of spikes, but buyers have magically come in and rescued the market. Whenever it's gone beneath this 140, 150, 151, 150 level, buyers miraculously came in and supported this market. So one of the things you really want to watch is a close under 150. 149.50 would be a really important level here, because that would be the first close since the middle of 2011 below that 150 level. So that's something to consider. Now, the interesting thing here too is we're not overbought nor oversold. So if we get something like that next week, you could have a severe drop-off. Now, a lot of people are, reluctant to predict much lower prices in gold. But if you do some basic counts here, from the top, which is 185 in GLD in October of 2011, and we're saying 150 is the point here, so it's $35 in this particular stock. So if you took that count, added it to the where gold is breaking down from that 150 level, right? You're talking about a potential 30 to 35 point drop in this, and that equates to almost $300 or $350 in gold. So that's quite a move. Let's take a look at the longer term chart here, the weekly chart, and you can see that this upward trend line here, which we've had in basically for the last year, this is an important support line, and you can see the same thing playing out on a weekly basis. Look, the bodies of the candle right here, of all those candle weekly closes, were on a weekly basis about the 151 level, right? On a daily basis, you got some closes, but by the end of the week, the market closed up, and we're right on that upward trend line that has been in effect for quite some time. So we close under this trend line, you can have some very severe liquidations, and I wouldn't be surprised to see that happen in conjunction with a real blowout of that upward channel that we showed you on the S&P. Now, meanwhile, in terms of support on the weekly chart, the 200 weekly right here is support around 138. So ultimately, the count down to that 120 level coincides, or the 125 level coincides with some pretty good support back here. But first level of support probably around 138 or so. So that's still a pretty severe drop in bullion. That's a $120 or $150 move in cash bullion gold. So that sort of wraps up the market outlook for this week. Again, the overall macro picture, definitely a shift, right? Normally you would think higher rates, lower stocks. In this case, potential higher rates, strong stocks point to an economy that's improving and can stand on its own legs. That's a good thing. So if that sustains, it's certainly good for the country. Maybe some other there are some other factors, intangibles like the changes in the Middle East, where potential regime changes could be positive for the oil markets and the Western economies. At any rate, have a great weekend and see you next week.